Candlesticks are not random. They are telling a story that happens in the market every second. If you don't know how to read this story, you'll be afraid. In this particular video, I'm going to teach you how to identify a trend, study about candlestick. So stay tuned with me and watch this video to the end so you can know how to enter the market as a sniper and make your profits, not a gambler. Welcome to day 4 of Forex Success Masterclass. I can boldly tell you that by the end of this very lesson, you'll be separated from 90% of struggling traders, because today we are going to unlock the skills of reading the market. At the end of this very video, you understand what candlestick is, how to read the forex chart, you know how to identify trends and direction. You will also know how to stop entering the market blindly. So let's dive in. We're going to start with, first, what is the forex chart? In forex, we don't guess. What we do is we read charts. What you can see on the screen right now is known as the forex chart. Now I want you to think what the forex chart is for a second. The forex chart is actually telling you the story of what happened in the market. So think of the forex chart as the heartbeat of the market. When you open your MT5 or your trading view, this is what you see. What you are seeing is what confuses a lot of persons. This actually is the price movement over a period of time. A price movement over a period of time. So I'm going to break it down step by step. Now you're going to see that the forex chart has 4 sides. This side you're seeing is actually the x-axis, the horizontal, which is actually showing you the time, and this other side is the y-axis, and the y-axis is showing you the price. So it's very simple. So as price move from this time, as price move at this particular time, this was the price at this particular time. So it's very simple. So when you enter the chart, don't be confused. This is the movement that you're seeing. You're seeing the price movement, the price of currency as it rises and falling during this time and on a real time. So if it was on a Monday or the Tuesday or this particular time you're watching, so if you pick up your MT5, you're going to see a price on real time. The market does not run on a straight line. It does not run on a straight line. It moves on the waves. It goes up and comes down. It goes up and comes down constantly. And let me tell you one truth. This ups and down is where the profit is. If the price does not go up and down like that, then there will not be a need for predicting. There's not be business. So that's why you need to study the wave, because the profit is in the waves. If you're able to study the waves as the price is going up and coming down, going up and coming down, you'll be able to study the waves and you're going to make profit. So at this point, we are starting with forex chart. Just this thing you're seeing here, what you're seeing here is simply a price movement at a certain period of time. So if you're doing back testing or if you're watching it right now, the price you're seeing there, if you go back at a real time, this is what price was at this particular time on this particular date, and that is what you're seeing. Let's go to something else. Candlesticks. What are candlesticks? As a newbie trader, this is part of the thing that will give you confusion, because when you open your MT4 or your MT5, you see all these things showing ups and down, and you'll be wondering, what are these things? Of course, you're not the only one. I felt the same way when I started, when I came in here newly. But I'm going to help you break down, tell you the anatomy, everything about candlesticks that you need to know at the beginning level. I'm going to do that. So to start with, let me give you the history of candlestick. Before now, there was nothing like candlestick. Now, the current candlestick that you see now that we're using is like this. It has a wick and has a body frame, then has another wick under. Good. Now this is known as the Japanese candlestick. Now let me give you a little background of how it comes about. The Japanese candlestick was discovered towards the 1980s by a certain man known as Steve Nissen. Steve Nissen, you can go and make the finding. Look at the pictures you're seeing on the screen by now. That funny face man is the person who founded this very particular candlestick. Now, during the 1980s, the Japanese were thinking how they can predict their market, because back then the only thing the only source of income was rice. So they wanted to know how the price of rice is going to be over time. So they started thinking of what they're going to do, how they're going to do to manage their business. That was how it started, and they started making findings. So around that time, this man, Steve Nissen, discovered the Japanese candlestick. So that's why it's called Japanese candlestick. So why is it even called candlestick? And it's because it resembles a typical candle. A typical candle is something like this. That's how a typical candle is, and it has a wick here, which burn the flame. I believe my drawing is okay. I believe that's how a typical candles look like, right? Good. So now this happened to be the wick. If the flame is not there, this is what you see. You see the wick here, and the body size is like this. This looks exactly as a candle. So since it looks like a candle, it's been called a candlestick. And since this candlestick was discovered in Japan, that is why it's been known as the Japanese candlestick. It's as simple as that, so do not confuse yourself. Now, what are these candlesticks? What you're seeing on the chart, this green and red line you're seeing is showing ups and down. Those are the candlesticks. Okay. Now, those candlesticks are the language of the market. Each candle, like you can see from year to year, is actually telling you the price during a specific period of time. That's what it's telling you, and nothing more, nothing less. So I'm actually going to help you break it down bit by bit. So let's say something. I want you to understand this candle in an easier way. So let's look at this market. Let's take this to be a bullish market. I'm talking about bullish market. Someone might ask me, why do you call this market bullish? So let's still explain that part before I go forward. In Forex, we have common language like bullish, bearish. So bullish means a bull is derived from bullfight, because if a bull should attack you, he will use his horn and put you up. Use his horn and push you up. So that's why it's called bullish market. So whenever market is pushing you up, you're making profit. You understand? Whenever market is going up, that's a bullish market. And that candle is represented with green color. With green color. And the red candles represent bearish. Bearish. Now, why is it called bearish? It's derived from bear. You know, when a bear is fighting, he's using his hand to trample down, to trample down, to trample down. So it's being considered that whenever market is trampling down, it is considered to be bearish market. Yes. So whenever we say bearish and bullish, what do we simply mean? We mean that bullish, the market is going up. Bearish, the market is actually coming down. And the bearish market is represented with red color, and the bullish market is represented with green color. So whenever you see a green candle, know that market ended with bullish. Whenever you see a red candle, know that the market ended bearish. Do you understand now? Now that is it. I still want to give you the anatomy of each candle so you understand it very well. So let's jump inside of it. Each candle you're seeing represents a time frame, a specific time frame. So if you're opening a candlestick, a chart at 4 hours, each candle represents 4 hours. Each candle represents 4 hours. It took me time to learn and understand this part. And if you're new, it will also take this time to understand this. It will take you time. So that's why I'm emphasizing this day, because this might be a shortcut for you if you're watching this video. And if you're actually learning something and like it, please kindly like the video. Just like the video. And if you haven't subscribed, you are the one that is doing it. So I advise you to subscribe. Anytime I come up with powerful videos like this, you'll be the first to receive it. So each candles represents one particular watch hour. So if it was a 4 hours watch hour, that one candle is 4 hours. If it is 30 minutes, it's 30 minutes. If it was 15 minutes, if it was 1 hour, I want you to have that understanding. So let's go to anatomy of each candles for you to understand how did the market ended up in green or in red. So follow me through. Imagine you're watching a 1 hour candlestick. So the market opens here at 1,000. But during that very session, buyers came in and pushed up the market as high as 1,100. Do you understand now? They pushed the market as high as that. Then at the same time, the market went as low as 950 and 950. But finally, it returned back and closes at 1,050. So now this formed the candle, the body of the candle. So this candle went this way. It opens here. This was the opening of the candle at 1,000. It closes here at 1,050. But during that same hour, market went up to 1,001. At that same hour too, market came down to 950. I want you to understand that this is what makes a particular candlestick. It opens here, it closes here, but it went as high as this and it went as low as this. That's what candle stand for. I don't know if you're getting the point now. Now, this is the body of the candle. This is the anatomy of each candle. There is nothing in or out in a candlestick than what I've just explained to you. The market starts here and closes here. Do you understand now? Okay, this will now be called a bullish candle because the market went up. That's a bullish candle. It went up. So whenever you see this is definitely going to be a green candle because it was a bullish market. It's as simple as that. Now that creates a movement of a candle which actually formed the body of the candle. Now because it went as high as this but it did not close it formed the wick of the candle. Because it came as low as this but it did not close it still formed the wick of the candle. So this actually creates a green candle, a bullish market. But how about the bearish market? How does it happen? Now let's take the same analysis on a bearish market. Now the bearish market opens here. Let's assume this time it also opens at the same 1000. The same 1000. Now buyers come in and push the market up. When they push the market up, possibly they push the market to 1001. That was what they pushed the market to. Sellers come in and push the market down. Possibly they push the market down to 800. Let's assume so. At the same time, buyers push it back again, and it went up to 900. Do you understand? It went up to 900. So now this forms the body of the candle. Remember, the market opened here, but it closes at 900 when it opened at 1000. So this happens to be a selling market. Sellers will more in power than the buyers. So this will be a red candle. Why this is a green candle? Because this one went down, but this one went up. Hope it's clear. It's as simple as that. There's no logic in a candle than that. Now let me still break something down. Let me add something that maybe you didn't get it well. Now, what makes a candle to be red is because sellers are coming in and pressing the market down. There's high demand in selling. Do you understand? So the market is going down. So it's a selling market. It's a bearish market. Do you understand now? Yes, that is it. It's a bearish market. But a green candle is buyers. Buyers are much in the market. So when buyers are coming, the demand is also high. The demand is high. So when the demand is high, it's a green candle. Hope that is clear. So a red candle is bearish market. It's when the price is going down. A green candle is a bullish market. It's when the price is going up. If you open the chart, there are many candles. There are hundreds of candles that are being formed every day. Different kinds of candles. And this can be very, very confusing. Don't worry. I'm going to help you. For now, I'm going to teach you candles as a beginner. In a way, you're going to become profitable in a very easy way without being complicated. For that reason, I'm not going to explain all the candles today because I want you to learn. In the advanced level, I'll teach you about all other candles that you might need to know. But let's start from the beginning. I'll teach you about 3 candles, and this is going to make it easier for you. So, we have the bullish candle. We have the bullish candle. The bullish candle is always green, except you change it on your chart. It's green. And we also have the bearish candle. The bearish candle. Now, the bearish candle is represented in red. What does it mean? The bullish candle means that the price went up. Now, the bearish candle means that the price went down. It's as simple as that. Now, there's a candle I want to talk about, and it's called the doji. The doji candle simply means indecision in the market. It doesn't have a body. This is how it is. If you see that the doji candle, this is what you're actually going to see. Now, what is it? That the market opens here at 1000. Like you can see, the market opens here at 1000. But it went as low as 800. And it was as high as 1200. But it's still closed here. So what actually happens is that when the market opens at 1000, sellers came and pulled the market down to 800. But buyers came and pushed it up again. Buyers push it from this point to 1200. Seller says, no, we no agree. They still push it back. And the market ended here at the same point it started. Within that same 4 hours or 1 hour or 30 minutes, depending on the time frame that you're actually opening. You will see this. Now, when you see this, this is a possible reversal signal. Let me say it again. A possible reversal signal. It's not 100% reversal signal, but it's actually telling you that something striking is about to happen. It is either it will reverse. Maybe if it was in an uptrend, it will break and return down. It is now going to be a change of direction. Or if it's in an uptrend, the next candle that is going to come up is actually going to tell exactly what's going to happen. Now, in the advanced level, I'll teach you how to create signal, how to create your own signal, master it down. I'm actually taking this as a beginner level so you can understand. So I don't have to complicate things. But this is the doji candle. Now, the doji candle means indecision in the market. Indecision in the market. By learning the candlesticks, how the candles behave, you'll be able to predict what is going to happen next. So whenever you see the doji candle, know that there's a battle, there's a banter in the market. So since there's a banter in the market, there might be a problem. So you'll be watching out for the next. After talking about the candlesticks, let's move to something very important, the market structure. Let me say this, the trend is your friend. This part is very, very important. In short, Most traders lose their money because they enter the trend against the trend. I don't know if you understand now. Now, the trend is going this side, you're going this side. It's just like river. Water is flowing towards this side. Now, instead of you to flow with the water, you're flowing against the water. It's going to be very difficult for you. You're going against the tides. It's going to be very difficult for you. You're going to struggle. So I want you to understand that way. So the simple thing is to trade alongside with the trend. Where the big dogs are, go there. If the market is going up, go up. If the market is going down, go down. So when we talk about trend, how do you identify the trend, the market structure? All you have to do is look at the direction of the chart. Now, when you look at the direction of the chart, you're going to see the market structure. It might be higher high, higher low, higher high, higher low. I know you might be confused with that if you actually knew. So what do I mean? If you look at the direction of the chart, you're going to see something like this. Then the market is going like this. You're going to see something like that, or you're possibly going to see something like this. So that is telling you the direction where the market is going, or you're going to see something like this. It's telling you the direction that the market is simply going, nothing more, nothing less. So what do you see? How do you understand it when you see it? So look at the chart. If you see it going higher low, going higher low, higher high, higher low, higher high, higher low, higher high, that is simply an uptrend. So if you plot a graph here, you see the market is going up. It's going up. That's an uptrend. That's an uptrend. But if you look at the chart and you see something like this, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, that simply tell you it's a downtrend. The market is going down. If you go against it, you fail. Or you look at it, you see something like higher low, it's going like this on the same range. The market is ranging. The market is ranging. So this is a ranging market or a consolidating market. The market is actually consolidation. So it's bouncing. It's bouncing on support and resistance. Support and resistance. It's bouncing. This is the support, this is the resistance. Now, whenever you discover the market is bouncing, that is a ranging market. So now this simple structure that I'm actually showing you is what is going to put money in your pocket if you know how to use it. So how do you trade? And let me show you how you can follow this structure and the simple thing for you to do. So let's say you are in an uptrend. An uptrend is an higher low, higher high, higher low, higher high, higher low, higher high. So when the market is actually like this, it's going up. Now what this simply means is that the market is in an uptrend. The market is going up on a stage, just like you can see as I'm drawing, or as you can see on the screen. Your job is very simple. All you have to do is that, so let's assume that the market have got to this point. The market have got to this point. All you have to do, get a ruler, go to your chart, plot a line like this. Plot a line like this. Now once you plot the line, all you have to do is hold, wait. Once the market pulls back to this point, to this particular line, to this your support, to where it's bounced, once the market pulls to this place, you know what you do? Just wait. As the market pulls down to that place, your job is very simple to buy. Buy as the market is going to reverse. Because the market has already shown you, you buy it at that point. Now you put your stop loss below here, put your stop loss below here and buy. That's all. Now what if you come and say that the market, okay, is now doing lower high, lower low, lower high, lower low. So the market is actually down. Do you understand now? It's very simple. That's a downtrend. Your job description is simply means to sell. That's just it. It's for you to sell. So you roll your ruler at this point and wait. Once the market retraces to this point, as it retraces and meets you at this point again, you sell because it's going to go down. You sell. It's as simple as that. This is very simple. Sell, put your stop loss here, put your take profit here. It's as simple as that. Don't worry, I'm going to teach you later how to enter the market better, but I'm just showing you how to use this. This is very, very important. Never you trade against the trend. If you enter the market and you cannot identify the trend, don't place a trade. Never you click buy or sell trade. Don't do that. But when you come into the market and you see that the market is actually consolidating, is going on a ranging, is going on a line. As a newbie, here's my advice for you. Do not place any trade. Don't buy, don't sell, stay away. Now the consolidating market is not really good for newbies. It is good for pros. Pros make serious money. Yes, so as you're growing, you learn how to trade here. But for now, I advise you stay out of the trade. When you come and say that the market is consolidating, it's going up and down, it's bouncing on support and resistance, bouncing on support and resistance, don't trade. Stay away. Wait for a clear breakout. Now, once you see a clear breakout, run trade. Why? The trend is your friend. Please write that. Don't never you forget that the trend is your friend. That's my message for you right now. We're actually taking this training to the end, so I want to give you a simple assignment. This is how we teach in our team. Yes, if you work with us in our team, we teach this. We give you assignment. After teaching, you give you a take home, go and practice. You go and see this thing in your eye and understand how it is. So what you need to do is very simple. Open your MT5 or your trading view after this video. Just do it right away. Don't procrastinate. Open your MT5 or trading view. Now pick any of the currency pair or use Euro USD. Let me give you straight so it'll be easy. Euro USD on a 1 hour or 4 hour time frame. Just pick that. Then count at least 10 candles back. 10 candles. Try to know how many are green, how many are red. Try to identify this. Then identify what is the trend. Is it an uptrend or a downtrend? Where is the market going? Is it going up or is it going down? Or is consolidating within that 10 candle that you are counting? Do you understand? Then mark where you have the higher high and higher low. Mark it. And once you mark it, screenshot it. Whether it's lower low or higher high, mark it. And once you do that, drop that in the snap it and drop it in the comment section, or type in the comment section before assignment done. Drop that there or drop in the group, depending if you're in the group, so that I can identify you that you're a serious person. Yes, let me tell you one truth: practice make perfect. All champions are people who practice. And like I said earlier, you cannot control the market, but you can control how you understand the market. Is in your hand. You can control that part. And candlesticks on its own are not random. Candlesticks are so precise. They are telling you stories every second about the market. It is only you that do not understand it. And once you learn how to understand this too, you stop being afraid. This is my message for you. You start trading. You start entering the trade like a sniper, not a gambler. So my advice for you is very simple. Study candles. Study candles. This thing holds your money. Identify the trend. And as a matter of fact, remember this: don't trade what you think. Never you trade what you think. Trade what you see in the market. If it is an uptrend, go uptrend. If it is a downtrend, go downtrend. That's my message for you. See you in the next video. If you haven't yet subscribed, kindly subscribe. Subscribe now, turn on the notification bell, because the next video that is coming from this, the part 5 of this, which will be talking about support, resistance, the entry zone. That's what we're going to talk about. So my message for you now is very simple. The support and resistance we talk about here, we'll explain it in detail. So subscribe now if you haven't done so, and turn on the notification bell and watch this next video that is coming up that you are asked to watch.